Today, we're breaking down 5 powerful investing strategies.
Wow!
These are strategies trusted by everyone, from complete beginners to seasoned pros.
If you're new to investing, it might feel like a financial jungle filled with endless questions and no clear path.
It's his first day on Wall Street. Give him time.
First, we'll cover a surprisingly safe hands-off way to invest in the stock market.
Then, we'll dive into dividend stocks.
We'll look at an option often dismissed as just for millennials, robo-advisors. We'll also talk ETFs for flexible diversification.
And tackle the big one, real estate. Think property investing is out of reach? Think again.
New doors are opening like never before for newcomers.
And if you stick around, at the end, we've got a bonus tip for you.
A strategy that might just change the way you think about bonds.
I don't think so.
Now, let's cut through the noise and dive straight into 5 beginner-friendly ways to put you on a profitable path. But first, a quick note.
While we're here to educate and inspire, this content is for informational purposes only and shouldn't be considered financial advice.
First, index funds. Let's start with one of the easiest and safest ways to dip your toes into investing.
Index funds are built to mirror the performance of a specific stock market index, like the S&P 500.
You know what they say, don't put all your eggs in one basket.
When you invest in an index fund, you're buying a slice of the whole market, not just a single company, which naturally minimizes the risk. Because of that, they tend to offer a steady, reliable growth. Sure, you can have ups and downs, but historically the S&P 500, for example, has yielded an average return of around 10% per year.
Not too shabby, right?
They're also budget-friendly with lower fees due to their passive management. Tracking an index keeps costs down.
Warren Buffett himself has called the S&P 500 Index Fund one of the best ways to build wealth.
In fact, he's noted that over time most investors can't beat the returns of the S&P 500, making it an easy, effective option for beginners.
So what about you?
Do you currently invest in any index funds? Let us know in the comments below.
Second, dividend stocks. The next beginner-friendly way to start generating passive income.
Not only do your shares have the potential to grow in value over time, but you also earn payouts just for holding on to them. Dividend-paying companies reward shareholders with regular payouts, often quarterly or annually. Many investors love the idea of reinvesting their dividends, which can create a snowball effect for compound growth, with each dividend payment helping to buy more shares over time.
Consider Johnson & Johnson, for example, a classic choice in the dividend world.
They've consistently paid and increased dividends for decades, offering reliability for steady income. Alternatively, a dividend-focused ETF like Vanguard's High Dividend Yield ETF lets you invest in a bundle of dividend-paying companies, adding diversification to your portfolio.
If you've enjoyed it so far, take a second to give us a thumbs up.
Forget it, Sonny.
Oh, come on. It will help us a lot in growing this channel.
Getting back to our list, dividend stocks aren't the only way to earn passive income. Here comes another interesting one. Third, robo-advisors.
Not into picking individual stocks or micromanaging a portfolio? Robo-advisors could be just what you're looking for. Think of them as virtual financial advisors that are always on duty, monitoring and adjusting your investments as needed. Here's the scoop. Robo-advisors use algorithms to build and manage a portfolio based on your personal preferences, risk tolerance, financial goals, and investment horizon. Once you set it up, the robo-advisor does the heavy lifting, keeping things balanced without you having to lift a finger.
Robo-advisors are quite popular for beginners because they make investing almost effortless.
In the US, top platforms include Wealthfront, Betterment, and Sophie Invest. Europe has options like Scalable Capital and Money Farm. It's a hassle-free, automated way to grow your money. Interested? Let us know in a comment below.
Or 2 or 3 comments. We don't mind, really. Fourth, ETFs, or exchange-traded funds.
These versatile investment vehicles offer some of the best flexibility around. Think of ETFs as a cross between stocks and mutual funds. Each one represents a basket of various stocks or assets, which could span different sectors or regions, giving you diversified exposure without picking individual stocks. This mix reduces risk while allowing you to invest in broad or targeted market areas with just one purchase.
ETFs trade on major stock exchanges, just like stocks, offering a level of flexibility mutual funds don't.
For instance, the Vanguard Total Stock Market ETF includes nearly the entire US stock market.
If you prefer to mirror just the S&P 500, there's the SPDR S&P 500 ETF, or Vanguard's S&P 500 ETF, which tracks the top 500 US companies. These ETFs ETFs allow you to invest in the performance of major US companies with a single share.
For those interested in specific sectors, like technology, the Invesco QQQ ETF tracks the NASDAQ 100, offering a slice of the biggest tech giants.
Wow.
Now, let's move on to an even more tangible investment. Fifth, real estate. Today, real estate is more accessible than ever, thanks to options like crowdfunding, fractional ownership, and REITs.
First up is real estate crowdfunding. Platforms like CrowdStreet and Realty Mogul allow you to invest in large-scale projects by pooling funds with other investors. When you invest, you're buying into a specific property or project, and it's usually a lock-in and wait deal, with returns potentially coming from rental income or property appreciation over time. Fractional ownership offers a twist, with platforms like Fundrise and Roofstock allowing you to invest in shares of various properties.
Fundrise diversifies your investment across several types of properties and regions, while Roofstock focuses on single-family rental properties that already generate income. Fractional ownership can be more liquid, giving you more control over buying and selling shares than traditional crowdfunding.
Then, there are real estate investment trusts, or REITs. These are publicly traded companies that manage income-generating properties from office buildings to shopping centers. Investing in a REIT is like owning a slice of their portfolio.
They trade on major stock exchanges, like stocks, making them accessible and liquid.
Plus, REITs must pay out at least 90% of their taxable income as dividends, offering regular income.
And that wraps up our top 5 investing strategies for beginners. Thanks for sticking with us. Now, let's get into that bonus tip we promised. But first, a quick reminder.
If you enjoyed this so far, give us the thumbs up and don't forget to subscribe and hit the notification bell so you never miss a beat.
Alright, for a fresh twist, here's a powerful alternative bonus strategy. Bond laddering.
Here's how it works. Imagine setting up a ladder where each rung represents a bond maturing at different times. For instance, you might buy bonds that mature in 1, 3, 5, and 10 years. As each bond matures, you can reinvest that payout into a new bond, creating a rolling effect. This strategy not only diversifies your portfolio but also smooths out your returns over time, reducing exposure to interest rate fluctuations. Bonds are generally considered safer than stocks, and by building a ladder, you avoid putting all your money into one bond with a long maturity, reducing the risk of locking in low interest rates if rates rise later.
In the end, investing is about finding what works best for you. So, take what you've learned, keep researching, and consider starting small to gain confidence.
Investing isn't for everyone, and it does come with risks, so be sure to do your own research and consider your personal situation carefully before diving in. And hey, if you're ready for more insights on the path to financial freedom, don't forget to subscribe and check out our other video on the subject.
Thanks for watching. We'll see you in the next one.